There are 5 investing mistakes that beginner investors could easily make this year. 2022 was an extremely difficult investing environment plagued by high inflation, rapid rate hikes, wars, multi-billion-dollar frauds, and a stock market collapse. But like 2022, 2023 has its own unique set of challenges, and I want to talk about what the investing landscape looks like over the next year and some of the key traps to avoid in order to do well in the markets. I wish I could sit here and list all the good and bad financial events that are going to happen over the next year, like I just did with 2022, but I can't, and the truth is, nobody can. The financial media like CNBC or even just a lot of YouTube channels is constantly filled with people making short-term predictions, particularly macroeconomic predictions about what interest rates or inflation or the stock market is going to do over the next 6 to 12 months. What they don't tell you is that nobody has any idea what they're talking about, and most predictions that you see, even from experts who appear on things like CNBC, end up being wrong and just forgotten in the litter of different predictions that people have made over time. And it's only the right predictions that get pointed to and praised, even though maybe even that same person has made 100 wrong predictions. When it comes to economics, there are so many factors and unpredictable events that go into what ultimately happens that it's very rare that someone is able to accurately predict what is going to happen over a 12-month period. And this is particularly the case in 2023 because there are some big key economic factors and non-economic factors that continue to influence the economy and will influence the economy over the next 12 months in ways that we can't predict. Primarily, this includes what happens with inflation. There are many people making predictions about what inflation will do over the next year and how the Federal Reserve will react to that, and therefore how the market will react to those things happening. But ultimately, nobody really knows what inflation is going to do. It, again, depends on a lot of economic and non-economic factors. So that leads us to mistake number 1 for today's video, which is following macroeconomic narratives. A good example of a macroeconomic narrative is what Michael Burry has been talking about on his Twitter page over the past week. He tweeted, "Inflation has peaked, but it is not the last peak of this cycle. We are likely to see CPI lower, possibly negative in the second half of 2023, and the US in recession by any definition. The Fed will cut and the government will stimulate, and we have another inflation spike. It's not hard." Burry believes that the US will have a repeat of what happened in the 1970s, where inflation began cooling, weakening economic conditions then led the central bank to lower interest rates to stimulate the economy, which ultimately helped in the short term but drove inflation higher and caused an even worse recession later down the road. That prediction is a pretty mainstream prediction that you'll see by a lot of economists at the moment, but it doesn't really tell us at all how to invest in 2023. Because even if we knew that Michael Burry was right, there's no way for us to know how the market would react to any of that unfolding. Would the market decline as the US goes into a recession, or would the market rally knowing that because the recession has occurred, the Fed is likely to lower interest rates? Or would the market react negatively to that, knowing that lowering of interest rates may exacerbate and cause another spike of inflation? This is just an example of how even if we knew what was going to happen economically, we have no idea how the market is going to react in the short term. So essentially, ignore the noise and invest over the long term. Mistake number 2 is trying to speculate on growth stocks. And this has been a bad idea through all times, but it's particularly the case in the current environment that we're seeing in 2023. In previous years, strong economic growth and low interest rates has meant that speculating on growth stocks during some periods has actually worked. And this all really comes back to interest rates, because when bond rates, essentially your alternative investment opportunity, are basically offering a near zero return, then investors are willing to accept a near zero return on stock market investments. And that essentially means it opens the door for investors to pay higher prices for businesses that may not produce profit in the next few years, i.e. businesses that are unprofitable but going through high growth with the promise of becoming profitable maybe 3 or 4 years down the road. A simple way to think about this is you may be looking at a business that is not profitable and won't make money for the next 3 years, but then is promising to make profit after the 3rd year. That may look actually more attractive than a bond if the bond is only offering you 1% per year for a decade. It's basically both of those things are offering you a near 0% return for the next few years, with the stock offering the hope of profits after. That free money investing environment is absolutely gone, with bond rates now approaching their historical long run averages. The opportunity cost to invest in businesses is significantly higher, or in layman's terms, with bonds offering 3, 4, 5% now, you actually have to be looking at businesses on a cash flow basis. And, this is something we've always done, but for people who were speculating on businesses that weren't profitable, those equations don't make sense anymore. And that's why we've seen a lot of speculative companies with these huge expectations grow a lot, but miss expectations slightly, and their stock prices get absolutely crushed. Tesla, for example, is down 60% in the last 3 months, and that's despite growing vehicle deliveries by 40% in 2022. Speculating on growth companies has never worked over the long term. Over the very long term, everything comes back to cash flow. But if you were speculating in the short term, between 2017 and 2019, where everything was rosy and there was free money, then 2023 is your wake-up call to stop doing so and start to analyze businesses based on their cash flows. Mistake number 3 would be to lose focus and change your strategy. Now, if you're speculating on growth companies, please change your strategy. That's not what I'm talking about. But if you're like the majority of my audience, which are likely either a passive investor or a prudent value investor, then 2023 isn't the year to shake things up. One of the hardest things about investing is staying the course and staying consistent as economic conditions change around you. You might see that incredible businesses that have been in your portfolio that have been thriving for many years, they may begin to see declines in revenue or just a slowdown in growth. They may begin to stumble, and it may begin to have you question whether you're going about your strategy correctly, especially if you've seen your stock portfolio decline over the past 12 months. But none of those short-term events are really any reason to change what you're doing. If you're a passive index fund investor, then the rules have been laid out for many years, and it's relatively simple as to why you should be staying the course. In fact, volatile markets for the passive investor just offer the opportunity for, if you're consistently buying throughout the year, to average down your price and collect an average price over that period where the markets are going up and down. Of course, volatile markets work against the emotional investor who believes they need to stay out of the market when things look rough and get back in the market as prices have been rising consistently and ultimately missing out on some of the best opportunities to invest. But if you can keep a rational head, and I'll talk a little bit more about this later, but if you can keep a consistent strategy of investing, then there's nothing you really need to change when it comes to passive investing in 2023. And it's very similar for the individual stock picker, although there's a little bit more attention need to be paid to the individual stocks in your portfolio. The way I think about it during tough economic conditions is, are the businesses in my portfolio suffering based on short-term factors or a long-term deterioration in the underlying business? Remember, it's completely normal for a lot of businesses to lose customers or have lower revenue during tough economic circumstances. People lose their jobs, people are more concerned about their savings, and the result of that is they spend less money. But ultimately, what decides whether you can be confident in a business is whether those customers will come back and buy those products and services when conditions improve. If a business sells a product that is exactly the same as competing products, or even worse, if it's inferior to competing products, then when customers tighten the belt and start saving more, and then when they look to come back, they may not come back to the same business to buy the same product. They may substitute for a better or similar, cheaper product. I have a lot of videos on my channel talking about economic moats and competitive advantages. I'll leave a link to a couple of those videos down in the description below if you want to check them out. Mistake number 4 is making emotional investment decisions. Emotion is one of, if not the biggest enemy of the investor, so it's important to place as many barriers as possible to protect yourself from making emotional decisions. For some people, this means that you shouldn't be picking individual companies. Warren Buffett talks a lot about how temperament plays a large role in your performance as an individual stock picker. So for the average person, or for many people, it may not be appropriate for you to be picking individual companies. And even when it comes to index funds, to avoid emotionally selling or buying into index funds at the wrong time, you can set up a dollar cost average schedule. You can automate your investments into index funds so you don't even have to think about it. Those payments are just simply going into the market regularly, removing the emotion entirely. And while it is unfortunate that emotion does play a significant role in our investment decisions and we have to protect against that, it also goes in our favor because savvy investors can exploit the fact that a large part of stock market movements, particularly during tough economic circumstances, is emotion driven, and look for opportunities to invest in companies that are undervalued. And then mistake number 5 for today is investing money that you need in the short term. Again, this mistake applies every year, but it has particular importance importance in this year, which is very likely to be another volatile year, impacted or influenced by a number of different economic factors. And it's really simple. Investing is a long-term game because the short term is unpredictable. We don't know what's going to happen over the next year, and even if we did, we don't know how the market is going to react to it. So the result of that is whenever I'm putting money into the market, I'm expecting that I'm not going to see that money again or be able to pull that money out for a decade. And a decade is long. Some people say 5 years, but even over a 5-year period, there have been 5-year periods where markets have been lower than they were 5 years before. And that doesn't mean you shouldn't be investing out of fear that, on the small percentage chance that the markets are down in 5 years compared to now. It just means that you need to be prepared for that. Investing money you're willing to forego and to let compound for many years, not money that you need in the next 6 months to pay rent or to pay down some kind of debt. Don't let the liquidity of the stock market lead you to think that it's easy for you to get your money out of it. I think you should look at the stock market in the same way that you invest in a property, which is when you put that deposit down and you buy a property, you're not really expecting to be able to turn around and sell that property tomorrow if you need it. You're hopefully investing in that property over a decade or more, and think about stocks the exact same way, even though you can withdraw if you needed to. This video is sponsored by SHARESIGHT, a comprehensive portfolio tracking tool that automatically tracks the performance of your investments so you can say goodbye to Excel spreadsheets forever. Unlike data provided by most brokers, SHARESIGHT considers the impact of capital gains, dividends, brokerage fees, and currency fluctuations when calculating returns, which gives you a complete picture of your portfolio's performance. SHARESIGHT tracks shares and ETFs across 40 different stock exchanges, 100 currencies, commodities, and even cryptocurrencies and unlisted investments such as private equity. Plus, SHARESIGHT makes tax time a breeze by giving you a simple but comprehensive view of your capital gains and dividend income impact. Use my referral link in the description below or head directly to sharesight.com/Hamish Hodder to try SHARESIGHT for free or receive 4 months of a yearly subscription.